Good evening, one and all.
Happy evening. Let's wait for 2 more minutes before we start the session. So, friends, I think we should start off without waiting further. I think my colleague will manage guests, allowing guests, etc. Okay, so this is one another interesting topic or the talk of the town. I can say that we wanted to choose and then share our learnings that we have had over the past many years. And uh, we just celebrated Chandrayaan 3 launch. And let's also celebrate the learnings that we have through, going through a lot of startups that we have come across in our journey until now. And I'm sure that each one of us will have something or the other as sharing. That being the case, especially the business world, in the business world, it can be the commercial aspects, it can be regulatory aspects, or any other business related aspects. That being the case, we thought we should, put across certain aspects that are critical or that may be important for any startup promoter that or any person who envisages to get into the startup cycle. So with that, I think let me start presenting my screen, and I'll hand it over to Mythili.
Okay. A very good evening to all of you. And thank you for joining this webinar. And I hope you have a lot more to take from this. We are basically trying to kind of get together, like Arun said, whatever the learnings from our experience of dealing with startups, we want to take it out to the whole world and tell it out, say that these are the challenges, address it, and this is how we can help you. So we decided to focus on the aspect of being funding ready and the regulatory aspect and the new challenges because of valuation. Um, 1 second. Yeah. So starting with the introduction of what is a startup, I'm sure most of us being in that space, we would know what a startup is. But nevertheless, I thought I should give a breakout. 1 second. Arun,
Yes, you have the control, Mythili. It's in presentation mode, right?
yeah, no, I'm unable to have that. So you might have to move
Reshare.
it.
Can I reshare it?
Or otherwise, if you can move it along, even I'm
I will
okay.
get done. Yeah, let
Yeah.
me finish
Okay.
this itself. Sure.
Okay. Perfect. So, basis of what a startup is, thanks to the government's interest in recognizing the efforts of innovation, we had the whole concept of Startup India and the whole hullabaloo around it because we have instead of India being part of a service industry where we are actually adding value overseas, we have started as a new enthusiastic aspect where we have become entrepreneurs and we are actually looking to create the product. We are looking to create the value. So that's where the government decided to incentivize it by saying that they have decided to what has it that they have decided to incentivize is the aspect of innovation and product development where you are able to create a certain product or a service and take it to the market and which has resulted in wealth creation as well as employment opportunities or with the big bang expansions that's happening. So they have specified that you are a startup only up to 10 years of incorporation, you can be called a startup. And they have given a threshold turnover as well, where they say that up to, as long as your turnover has not exceeded 100 crore, you are still within, can be called a startup. And once you, any of the financial years, your turnover exceeds 10 crores, you stop being a startup. Now, though this is what most of the industries are in the space, most of the undertakings are in the space, we still have to be recognized to be called a startup. So it doesn't start with we ticking all these boxes. We have to go one step further and make an application to the DIPP and actually get a recognition as a startup. So all the benefits that flow to us, even though we tick those boxes, it doesn't actually happen unless you have the startup recognition that has been handed over. Now, having said that, I will move on to what are the aspects of funding that, what are the general aspects that we need to do in order to be funding ready. When you say funding ready, it can be seed funding or it can be onto, some people would be bootstrapped till a series A where they have a good product and they want to take it to the market. And at that time, they actually go for funding. So it could be any of those stages of funding. So what are the basic requirements with regard to fundraise? Now, one of the most mainly the three R's that actually come is that the compliances, which we would call as having the house in order. Have you being compliant on all aspects? It could be various regulations, having a certain process flow in terms of are you do you know what you're looking for? Are you clear with what your business is and what you're looking to raise? And then also having a good narrative in respect of your business. That is saying your business model has to be very good and you have a pitch deck which basically gives a narrative to what you're here to provide to the world in terms of an idea or a concept. So, and these should be scalable. So when I say scalability, that should be evident from the business model that we have. So what are the main requisites before a fundraise? Like I said, you need to have a narrative. The narrative of your business has to come out through in the pitch deck. A pitch deck is very, very critical because not we don't get too many opportunities of having a face on with the investor. So what you want to communicate to them about your business, that's it's almost like your kid. You want to talk about it, but you can be very passionate about it. But when you have like a 30-minute window to actually tell about your business or what you are out to sell, you need to be very effective. So that's why the pitch actually comes into play. Now, you can have a great narrative, but a narrative is not complete without the proper numbers backing it. So that's where the business model needs to be really good. You need to have an entire model which proper cost drivers or revenue drivers and actually showing in terms of numbers year on year on a month on month basis, saying what is the potential that startup has, where it can scale, how many customers you would add, and what would be the cost of acquisition per customer, what is the cost, unit cost level metric, saying that this is my gross margin, this is my first contribution margin, and these are my overheads, clearly laying out. Now, a model where I'm emphasizing the model is very, very critical is also because the model kind of gives you an insight as to what is your runway and what your ask is. So, having a proper good business model also helps you go demonstrate to the investor, saying that this is my runway, this is the time period I need before I am market ready, or this is the time period I need before my big bang expansion to happen. So you need to demonstrate it with the number. You can have a very good product, but it will fall flat if you don't have a great model to say that these are your expectations. This is the revenue achievability. So that becomes very, very critical. And being aware of the space that you are, that is in the funding space, your peers, your competition, being aware what has been their funding round, what is their model, and how you can differentiate yourself from your competition becomes very critical. Because when you go to an investor, the investor, because they are going to put in money into the business, they would also understand the kind of sector that is going to be there, who are the peers and who are the competitors. So you need to raise your awareness to understand who are your competitors, who are the other people who are there in this. They may not be a like by like comparison, but still an awareness saying how much they have raised, which stage they are in. You need to understand and how you can differentiate yourself from a competitor. Why is it that the investor has to invest in you? That would be a critical question to answer. So that you need to have an answer for. So you need to detail it out in the pitch deck. Now, apart from that, if you are a product company, it's very, very critical to know where your IP is. Is it registered? Because an IP would be something which the investor is going to back and going to invest in your company based on that. So it becomes very, very important to understand whether what is the structure you want to take for the IP. Have you got it registered and is it all clear? You should be able to demonstrate, because when you're taking the product onto the market, you should have complete ownership of that particular idea. So that is very critical. And then you have what is called as a founders agreement. A founders agreement is something which is good to have when you have two or three promoters who have come together and who want to take the concept to reality. So now a founders agreement will actually talk, it is like what do you call, it is need not be like a registered agreement, but it can be a kind of a memorandum of understanding between the promoters where they very clearly detail this will be our percentage holding, and this is the lock-in that we have, and these are the roles and responsibilities each of us will have to undertake in this particular what do you call, in this particular venture that we are going into. And any decision that we take which is in relating to the idea or taking the idea to the next stage, there should be a sort of consensus amongst the founders so that they will be able to scale up easily, and there is always a single thought with regard to the agreement. So that becomes very important with regard to the narrative. Now, this is the pitch deck is almost like the heart of your entire narrative. And it has to be really good. And the time you have for pitching will be very, very limited. And when you have that window, you need to be able to communicate exactly what your company is, what you are out to solve, what is the problem that you are trying to address, why is it unique, why is that problem so important that it has to be solved, and why is it that time is of essence, why is that you need to go into that expansion now. What are you in terms, I like mentioned before, what is your differentiator and who are your competition? What is the uniqueness of your product? How good is your product? Can you fit in easily? Is it something like in terms of deployment, it is faster? Or is it in terms of ease of understanding? Is it easily customizable? How good are you from your peer in terms of the product? And why would a customer actually come and buy it from you? So you need to build a story around it and be able to effectively communicate to them. And this is with regard to the product side. And then you have what is called as the team size, saying that what is the background that you have that you demonstrate to the investor that he needs to invest in you. It need not be a single person. In fact, having a team of great people with great ideas and who have been and who have had a good run up to wherever they have been, that is a good way to actually demonstrate to the investor that we have a great team and the team is cohesive and it's able to take it to the next level. And finally, there is the question of what is it that the investor wants to invest in. So if it is a smaller market share, he might not be interested. So how do you grab the investor's attention and saying, this is your differential, but this is the potential of the investment. So that comes in capturing the market size, saying that this is my whole market that I have. And I am trying to capture only a certain percentage of the market. And this particular percentage of the market, if I actually capture, this is in terms of revenue and this is in terms of profit I'm able to create. And this is the kind of valuation that I can aspire for. And you will be able to determine your runway also based on that. And the final talking slide after all this narrative will finally land up in the financial, which is the numbers. So your business model is what is going to finally, you might have 15, 20 slides, but finally the talking slide will be your financials in terms of what is it that you can achieve, what is your ask, and what is your percentage offering, and how much are you sure that this is the revenue you can, what is the kind of revenue you're going to have, is it a product, what is your margin on that, and how much is the net profit you can do in next 3 years, are you going to be EBITDA positive, which is your break even. So everything finally boils down to the numbers. That's why I reiterate saying that it's important to have a very good business model in place. And not only it should be a single scenario model, you might have aspirations and you might have an optimistic picture saying that, okay, if everything goes great, I'll be able to generate so much revenue. But having one scenario will not be great. It is, you need to have a sensitivity analysis saying, okay, what is the, if I'm able to do so much percentage of the market, okay, where am I going to be? Okay, if it is not perfectly great, if everything doesn't go as I want, but I am somewhere midway, then what will be my revenue scenarios? This will also help you simulate in terms of what can be your valuation from a worst case scenario to a optimistic or a best case scenario. So these aspects you need to comprehensively build into the model, and you have to make it iterative so that it's very easy for anybody to simulate it, and you'll be able to determine at each scenario what will be your ask, how does it work. Now, proceeding on to the next level, which is the having the house in order. Now, most of this we have is this is aspect of taking your business to the investor. But what is it happening in your company? Okay, you have set up the company and you have created the product, and the product is ready for launch to the next stage. So, what do you need to do in order to have the compliance in order at your in your company? Now, it's sometimes what we've seen in a lot of cases, it's been a little quite sad where you see a lot of compliance slipping up. And all these compliances have an impact in terms of your funding, because there would be a lot of, there might have been, you might have done something, you're not aware of it, you've gone ahead and done it, but there might be exposure to some penalty or some offense that you may not be aware. But when you actually start cleaning up your compliance at for your company is when you realize, okay, these are the places we have slipped. So you need to have all that clean, because the investor, when he actually puts in money, he needs to be very sure that whatever is there, he is actually, the money is used for the business and not for actually paying any of the penalties or any other repercussions for what was done previously. So this becomes very critical. So you need to have you need to have minutes, you need to have direct appointments proper, your minute books proper. You have to ensure that your company has filed the income returns for under company law, under income tax returns, your GST filings are in place, and there is no less exposure to penalty would actually mean your due diligence is more effective and it's much easier. Now, apart from this, also what I wanted to emphasize in this aspect is that create a concept of having an MIS in place for your business, because an MIS is like a good habit to have. If you have the habit of doing an MIS, managing the business post funding becomes very easy, because you have imbibed it as a culture in your organization, and you are always aware where your shortage of fund is, where your finances are falling short, by which month you would need that funding, what is the deficit, that it would help you have a better idea as to what your runway is going to be. And you can always go and revisit your estimates based on what you have. You have the model in place, which will be monthly, and then you will have the financials, the MIS also talking. So you will be able to compare, and you will able to do adjustment to your estimates and see where you are as against your budgeting. So that is becomes very critical. And you need to, if you have invested in technology, it's quite important to know how much have you actually invested. Is it captured in the books? Sometimes it would have just been through the promoters funds and it would have gone out. But you need to capture effectively as so much has actually been spent on technology, so that if you have something credible built in the company, you need to determine how much it is and what is it that you have created value in the company so far. So that is very, very important. Another critical aspect is with regard to the ESOP pool. Now, typically, before a funding investment happening, most of them would insist this as part of their term sheet, where they say, please create a carve out for an ESOP pool. Now, ESOP is one particular mechanism for compensation, but ESOP is not the only mechanism. If you have to do it for advisors, you also have other alternative plans like a cash settle plan, which you can roll out for advisors. Now, this becomes critical because a person who puts in money doesn't want to face a dilution subsequently. So before they bring in the money, they would always insist that have a ESOP pool in place. So you need to also think about that. What is it that you need to create in terms of a pool size? It could be a threshold of 5% or 10%, but have a long period in view and think how much is it that you're going to dole out in terms of people who are also creating value for you in the organization. Now, the other part is with regard to the cap table. Cap table management itself becomes very critical. You need to know that, because that would help you understand better what are your dilutions and how much are you diluting with every round. This knows how much is your value is also eroding every time you actually give out equity to somebody. Okay, so this is how a general funding cycle will look like. You have an investor pitch that is happening. Then post investor is interested, you want to take the pitch forward. You have what is called as the term sheet that is given out. It is like an MOU between you and the investor. And then you have the investor will insist that you will have to have a due diligence that needs to be done. From due diligence and term sheet arises the SHA and SSA, and based on completion of that, you have the investment and the next exit. We'll have a poll coming up right now. If you could just take a minute to answer that. And I will let Arun take over for the next part of the funding cycle.
Thank you, Mythili. So, friends, please address the poll, 30 seconds to 1 minute, and then we'll hop on to the next section. Okay, parallelly, let's get on to the next session, next part of this session. Friends, now that you have understood what should be done prior to getting into the funding situation or the funding activity, and what kind of process that goes into the funding activity, it's all the more important for the people in the business, the promoters or the CFOs of the promoters to know what next during the funding situation. So the start of the funding activity starts with term sheet. Of course, term sheet starts only after identifying your prospective investor, and uh, and then you sign off a heads of terms or memorandum of understanding or term sheet, whatever name it is called. It's very important and very critical, as Mythili said, that term sheet is very important in funding cycle, and it sets the tone of the entire funding that happens in that event. So let's quickly look into what is that term sheet. Term sheet is nothing but list of terms or list of terms and conditions, and the parties to this term sheet are nothing but your prospective investors or identified investors who intend to invest in your business, and the company and the promoters. These are the parties generally are part of the term sheet. Now, the term sheet, of course, we are not getting into what type of terms and conditions. Of course, we will touch upon a little bit in the subsequent slides. But the term sheet can be binding or non-binding. What do you mean? What do we mean by binding? So, if there are non-compliance by any of the parties in case of the binding term sheet, the other party, aggrieved party, can go after the person, the party who have defaulted. So, of course, this is only theoretical. We have not really seen where term sheets have been taken to the court of law generally. However, this is the concept level or the theory level that we have come across. And of course, there are certain times where investors insist for binding term sheets, so that the promoters or the promoters do not do the term sheet shopping. At the same time, promoters want clarity and confidence in the investor who promises to invest, and hence the promoters also may insist for binding term sheets. So it is a win-win, or it can act in either way. And this is where most of the most of the critical terms are agreed upon in a broad way. Of course, these gets detailed and documented in definitive agreements. However, this sets the tone as the base, acts as the base for the engagement with the investors, and hence, because it sets the tone, it has to be clearly worded. It cannot give room for ambiguity, because it can be very dangerous when there are ambiguities or confusions brought up, and hence it has to be worded properly, and hence a legal expert is necessary while drafting the term sheet. Of course, next to the term sheet, that is the term sheet once signed off, it paves way for definitive agreements. What I mentioned earlier, it is nothing but your shareholders agreements and share subscription agreements, where all these terms and some more additional terms are also captured in a detailed way. So that's where we call term sheet is like an engagement, while definitive agreements are like a wedding in case of a marriage. Okay, let's move on quickly. So let's understand quickly. We have tried to populate the crux of the term sheet or the main terms of the term sheet, uh, which which is seen often, which is seen in most of the term sheets. That is what is the, of course, the parties I spoke about, who are the parties to the term sheet. Next is what is the company, that they talk about the company. And next is what is the business they are into, they define or detail a little bit more about the businesses. And then they talk about who are the promoters of the in the business. So promoters play a key role because they come with certain responsibilities, certain duties, and certain indemnities also. So naming the person as a promoter also is very, very important. There can be certain director level key people in the in the management or in the business, but they may not act as promoters. So hence, it is all the more critical for the promoters to decide who should be named as promoters in the definite level. After that, we generally look at what is the investment size, what is the valuation, what type of investment instrument that they are getting into. Of course, we'll touch upon on this instrument little later. Then we talk about on the cap table side, we talk about pre-money, what is the post-money valuation, if there are any ESOPs or SARs or phantom stocks to be carved out for key people, key employees in the organization. What is that they talk about? And the rights and preferences of the investors. That is, what is the liquidation preference? Let me touch upon a little bit more here. What is liquidation preferences? What the preference that the investors carry in case of any kind of liquidation. The liquidation need not be the final closure of the company. There can be an exit. Exit also is called as a liquidation event in case of in investment world or startup world. And hence, when there are exits, what kind of preferences investors get is captured in liquidation preference. And then, are there any dividends promised? What voting rights that the investors carry? Are there any reserved matters where, irrespective of what percentage of vote or what percentage of stake they hold, they can exercise? And in case of board composition, are there any board seats that are provided to the investors, or it is just the investors without any board seat? So these are different rights and preferences that the investors look for, negotiate, and get documented also during the investment, during the term sheet. And of course, there are anti-dilution clauses. Let me again touch upon a little bit and explain a little bit more here. What is anti-dilution? Let's say in the subsequent round of fundraisers, if there are downward valuations happening for whatever reason, then the initial investors' value get eroded. So there is a value erosion for the initial investors, and hence promoters, uh, you know, promise or commit to make good the value erosion that the initial investors have gone through due to the subsequent downward valuations. And hence, these clauses become very critical. So there are a few examples. There is something called full ratchet model, or there is something called weighted average model. Basically, these are different models that are adopted to compensate the early investors in case of downward valuation. And next, there is something called founder share lock-in or founders vesting. Basically, this is nothing but the investors would want founders to be vested and invested into the company and into the business. It may so happen that the founders, this is from the perspective of the investor, it may so happen that investors feel that founders should be locked in, irrespective of founders starting the entity, starting the business activity. So that being the case, founders are locked in with their share. That is, their shares are not freely tradable. They cannot go out in the market and then sell it and exit the business. They cannot do that. And hence, this vesting schedules or lock-in schedules are brought in. And accordingly, over a period of time, let's say the lock-in, for example, if it is 4 years, then founders are allowed to trade in only 10% initially or 25% initially. And that's how they get staggered. This is where the founders are locked in so that there is some kind of binding, and then there is seriousness amongst the founders not just that they get the money, get the investment, and then spend it out and get out of the business. So that is where the founders lock-in comes into play. Of course, there can these vesting schedules or lock-in schedules can always be accelerated based on different situations, and there can be waivers from the investors in future. Apart from that, there are other conditions that comes into play in case of term sheets, such as condition precedents. That is, there are certain conditions that needs to be acted upon before the investors move ahead in the funding situation, funding cycle. Exclusivities, whether these term sheets are exclusive for the investors alone for a certain period of time, or can promoters enter into parallel term sheets with other investors. So that is where this exclusivity comes into play. And of course, these can be locked in time bound also, where the investors have certain time frame wherein they have to act upon. Otherwise, the founders are free to look out for another investor. Of course, they talk about how the due diligence should be done, what is the time frame, what are the areas of due diligence to be undertaken. Of course, due diligence itself is a topic in itself. Why it is done? Basically, the investors, though they know they have met the founders, they have interacted, they would not know how the business is carried out, whether it is prudently done or are there any red flags, are there any observations which may impact the value of the company or the investments value of the investments that they have made, and hence due diligence is a must in any investment cycle. And we have seen almost all investment activities, due diligence, it doesn't go forward without an due diligence happening. And that these, as I mentioned earlier, these term sheets can be binding or non-binding. Of course, one of the critical terms is exit clauses. How the investors are given exit. This is very, very important, and it has to be documented in the definitive agreement. However, as a tone being set through the term sheet, it gets captured in the term sheet also. So generally, the exit situations are where the promoters promise for IPO, promoters promise for buyback of investor shares at the end of certain term. It can be 5 to 7 years, and promoters buying it themselves after certain period, or promoters bringing in new investors or private equity players to give an exit to the early stage investor. So these are different stages, or different types of exits that one can look for. Okay, so quickly, as I mentioned, due diligence is very, very critical um, for the investment cycle to move forward. So what does that mean for a promoter? Obviously, the promoters have to expose their books of accounts, their transactions, and their activities over a period of last few years to the consultants or the person undertaking due diligence, who are appointed by the investors, and they thoroughly go through everything and anything that the company has gone through in the past. So generally, the areas that are covered are business due diligence, which the investors themselves do, or they engage experts in the field. And apart from that, the areas covered may be financials, operations, litigations, taxation. When I say litigations, legal aspects, taxations, and other statutory compliances. So these are the main areas. Of course, apart from this, there are HR, and there are other industry specific areas that may come up with. For example, if it is R&D, pharma, are there any approvals from the board? If it is into manufacturing, are there pollution control regulations, covered with? If there are laborers, then are there any laws that are needs to be looked into from labor perspective? Factory regulations, if there are factories. So these are different types of industry specific or business specific regulatory that needs to be looked into at the time of due diligence activities. So of course, when I talk about due diligence, the outcome of the due diligence results in the action items. The action items may be in the form of conditions precedent, where the promoters and the company has to comply with before even they get into the closing date or the getting the investment fund into the company. Those are covered under condition precedents. Apart from that, there are certain things called representations and guarantees, where the promoters provide representations on certain aspects. This is mainly from full disclosure perspective, where promoters have to disclose everything and anything about the business and about themselves to the investors. And this also can result in indemnities. For example, if there are any contingent events that the business has entered into, and then because of which it may result in losses or liabilities to the company, those are to be covered, and that should not impact the investments made by the investor, because investors' intention is to put in the money to grow the business and not to cover the liabilities or the contingencies that the business face. And hence, promoters are asked to indemnify in such situation. So these events may or may not happen, and hence, to protect investors' interests, these probable situations in futures that may arise are covered through indemnities, where promoters are asked to indemnify the company or the investors. Of course, there are certain conditions or the certain action items that may not be so critical for the business immediately, or not critical for the fundraise immediately, but has to be complied with. Those they are categorized under the bucket conditions subsequent. So these are the things that due diligence will result in. Of course, due diligence also will provide if there are any showstoppers based on criticality and materiality. The investors decide whether to go ahead, proceed with, or stop the investment activity. Yeah, very briefly, the other two definitive agreements that we commonly see are shareholders agreement and share subscription agreement. I'll first touch upon share subscription agreement because it is for the subscription of shares. That is, in case of primary round where the investment or the money is get coming into the company, into the business, share subscription agreement is important, where the shares get subscribed by the investors. The terms and conditions of these shares are captured in that agreement. And of course, for before the money comes in, as I mentioned earlier, the outcome of due diligence are captured in the form of condition precedent and condition subsequent. Coming to the shareholders agreement, it is an agreement between the existing shareholders, the company, and the new investors who would become the shareholders of the company post investment. So it will actually help in taking this forward, taking the business forward along with the new investors until the next round of funding happens and new set of shareholders agreement are signed off. And hence the shareholders agreement is very, very critical comparatively compared to share subscription agreement. The reason is shareholders agreement that acts as the guiding document for the promoters and the investors as to what kind of terms and conditions have been agreed, what happens in certain situations. For example, if there are investors who want to exit, what kind of terms that are agreed upon between the shareholders, what are the rights that the investors have the board seat given, if the board seat is given, what kind of decision making that they can get into, and if there are reserved matters agreed upon, what kind of matters that shareholders or sorry investors have to participate for. Generally, investors may not like to participate in the operations unless it is a strategic investor, and hence, if there are financial investors only, they do not want to get into operations. But if there are critical decisions to be made, then they are supposed to be approached, and shareholders meeting might have to be done, and those uh, terms would have been agreed in the shareholders agreement, and reserved matters would have been listed. So these are certain examples as to what terms and conditions that go into shareholders agreement. But of course, it is quite exhaustive. It runs into hundreds of pages, and of course, every situation, worst case situation, can be documented so that in future, without ambiguity, those worst case situations can be addressed. Moving ahead, what are the key terms? Of course, we have talked about these things in the previous slides, so I'll quickly run through. Of course, the stake, the valuation are spoken, the board seats are spoken about, liquidity preferences are spoken about, types of instruments and conversion terms. For example, the investors may not prefer to be participating in equity shares, but they would want to participate in preference shares or any other instrument, which we will touch upon a little later. And then the conversion terms. When would these instruments convert into equity, and what are the terms and conditions that get attached to these conversions? Those are the aspects that are covered here. And then, of course, we spoke about CPs and CLs, the condition precedent and the condition consequent. Then promoter lock-ins, we spoke about a little earlier. Anti-dilution also we spoke about. And then, of course, shareholders' rights, which generally, apart from what we spoke about earlier, it also includes tag-along rights, drag-along rights, right of first offer, right of first refusals, preemptive rights. These are different rights that shareholders would insist, and it gets documented. It gets negotiated, of course, and also get documented in these different agreements. Yeah, so I think it is over to you, Mythili, from here.
Thank you, Arun. Thank you so much. Now this comes to the part where there is so much complexity, why funding gets very, very interesting. Meanwhile, if we can just have one quick poll, it'll be good if you can just take a minute.
Yeah, and we will earmark 15 to 20 minutes in the end, towards the end of the webinar for Q&A. And meantime, if there are any questions, you can also put it under Q&A section, and we will take it up during our Q&A section.
Okay, so I'll go ahead with this. So we have seen the entire aspect of what are the different ways the term sheet has to be drawn, what are the definitive agreements. Now comes actually to the money actually coming into the company, and what is the instrument you're going to give. Now, traditionally, we have always been very comfortable with three known instruments. We had initially debt and equity. Then we had a little complication. We created what is called as a preference. Now, with the ability of the human mind to explore new hybrid instruments, we have come up with a new age instruments, which are more like OCRPS, CCDs, convertible notes. All these are different names given to what are the at whose behest can this conversion takes place. So these are different types of instruments we have seen. So we are or the complexity actually where it adds is you have to go through the agreement in order to understand what exactly are the rights that you have given to them. What is it? Is it a kind of a debt? When that person decides to convert, can he convert at his behest, or is it at the option of the company that the person converts? It can sometimes even be a redeemable preference shares, which is very simple. But we still create because of the funding cycle, and everybody would like to buy time in the startup and see where the funding cycle is going and see whether they can actually get a better exit. They generally have a different type of convertible note. Now, the other concept of convertible notes, the new concept that was launched, which are exclusively for startups, has been the convertible note. Now, convertible note, why did the government actually help create this kind of a new instrument? It is basically because when a startup is starting out, for it to decide whether what will be the valuation and how much is going to be the stake offered, it is very difficult when it is a very early stage startup. So, in order to tide over this kind of an issue, the government said that, okay, you can still go ahead and issue, which can be in the form of a debt currently, but you have to convert it at a later stage based on whatever is the funding round subsequently that's happening, when you know for sure this is how my funding cycle is and this is how my growth pattern is. So this is where I am, and you're able to determine your value. You can convert at that point of time. So that was the logic, and it was this was something which has been exclusively like a startup instrument, and you don't see any other entity actually issue this. It's only on the startup phase you actually see this particular instrument. Now I will touch on why how this complexity of different instruments has an impact. So I will take it up subsequently from on a regulatory space. Now moving forward on cap table and dilution. Now, understanding how the cap table works is very important, because this metric actually provides how much are you diluting at every stage. The entire thing is almost rolled out as a service where they say it's like a cap table management, because at every stage that you're having a funding round, what you're doing is actually effectively seeing you're managing your cap table, saying how much is the promoter equity, where did we start, and with every time you give a portion of yourself through the company as a stake sale, how much are you diluting, how much is your value actually reducing. There is one side where there is an increase in the value of the entity because of the growth spurt, and the other side, because of your percentage holding is also coming, because you're going to give out a certain percentage of the company to the investor for him to have brought in the funds. You're also diluting in the process. So at every stage, this every funding, you start with your cap table where you say, this is where I am, this is what I want to offer, and this is where my wealth is going to be. So different funding scenarios that happen is one is through a primary funding, or sometimes it can be a secondary transfer. But now, when I say primary funding, is when somebody just brings in money and puts it into the company, and you have against that investment, you are actually offering a security and you are allotting a stake in the particular entity. Now, secondary transfers, as the name says, is that it is just transfer between two individuals. There is no change in the value of the company. The number of shares in the company stays as it is. Now, the pre and post money value also remains stays, because there is just going to be between two individuals it's happening. And you have a third mix to add to a complexity, where you will have that some of the promoters also would like to dilute their stake, and instead of getting the money into there, they also take a little bit of exit during advanced stage of funding, say maybe a series B or series C. They would have a secondary exit that is happening. So they also see some money in the whole process, because they have managed to build an asset which is of substantial value, and it's only the company which is actually using the money. Now they also need to see, for whatever growth they have actually enabled the startup to get, they also see a certain amount of exit. So these are the different scenarios that happen. Now, the whole process, what is what I have tried to capture through these scenario analysis is how much is the pre-money value and post-money valuation actually happening. Say, for example, two promoters are starting out. It's a very clean, where you just allocate equity. You start with a very basic share capital, and then you have started trying to build a product, and you have started putting your money into the entity, and you have built a certain to a certain stage. Now you realize that, okay, I have brought it to a certain level. I need to onboard one more person who is not being able to spend time because he's been somewhere else, and he also is able to bring substantial value to the company and can actually take us to the next level. So you bring them as a co-promoter who actually comes in. It can even be a director or anybody who is going to stay vested longer in the particular entity and create and take the idea to the next level. So what you might do is still you've not gone into a certain revenue cycle. You are still pre-revenue. You still want to transfer. You can create a jig in your, like how I called about the founders agreement, create that and say that, okay, from my stake, I'm actually parting out so much equity to you, so that you are also going to be part of this growth story. So that's how the cap table adjusts there. Now, once you are going to be funding ready, before the investor comes in, he is going to ask you to mark a certain pool, which is called as the ESOP pool. Now you see it has been 50, then it comes to 40. Now it has come up to 36%. The value of the entity is also increasing. In the whole process, this pre-money and post-money has not changed because it's just been readjustment of share within the entity. There has been no funding that has come in. It's just people transferring between themselves. Now comes a stage where there is a primary fundraise that is happening, and the investor is going to pick up a certain stake, say 10% stake on the post money. So this is the value that they are bringing. Now the investor is going to ensure that he is not going to dilute. After he comes, he is not going to ask you for a carve out. He will ask for a carve out before, so that at the end of the fundraise, he is going to be holding a certain stake in the company, say 10%. Now you can see how the promoter funding is also moving along with it. Now, there is a next combination where I'm saying is where the promoter is also taking a bit of an exit, where the value has substantially increased. Now you see from 10 crores, it has gone to 15 crores. Now, if you notice in scenario 4, you have a post money and pre money there because fresh funding has come in that has added value. So your post money valuation is 10 crores in which the investor has picked up a 10% stake. So before the money has come in, that is your pre money value, which is 9 crores. Now, in the next case where a promoter is coming with a 15% stake, he's going to bring in some money and is going to get shares allotted against his name, as well as he's going to take a little bit of stake from the existing promoters, giving them a bit of an exit, whereby they also dilute and their stake is going to come down. Now, part of this money is going to go to the promoter's kitty and part of it is going into the company. So the money going into the company is going to decide how much is your pre-money valuation and your post-money valuation. So that's how, even though it is a 2.25 crore inflow into the entity, the money increase is that you don't have it from 15 minus 2.25, but only to the extent of 10%, which is roughly about 1.5 crores, that you have that dip in valuation. So your pre-money is 13.5 and your post-money is 15. So this you need to have an analysis throughout your funding stage so that you can keep track of what is the dilution, how each dilution is happening, and every transfer, either in the form of a secondary or a primary, what is the impact it has on the valuation. And this whole exercise is what makes it all worthwhile because you see the value of your entity also growing up and the wealth that you're accumulating over the period is also going to go up. So you need to, it's important that you need to keep track of it. Now, moving on to, we have talked about the basic premise of what all is required as part of fundraise. I will going to shift gears a little and I'm going to take you to the other aspect as what is all that is about the halabulla of being a startup. Do you have any benefits? Now, taking it forward, this is an interesting aspect that has come. Now, when we have dealt with a lot of clients in our space as part of advisory, we've always realized that they say that, okay, I've been in innovation and I'm creating something new and I'm going for this thing. I automatically am eligible to be a startup. Yes, you are a startup. Like I said, you can be a startup, but you need to please go get your registration done with Startup India and get a certificate say that you are recognized to be a startup. But income tax doesn't stop with that. They like to hassle us a little more. So where they say that it's not enough that you are a startup, I will give you some benefits as part of government policy measure. I'll give you some extra benefits, which is going to impact you substantially. But for that, you need to be an eligible startup. So income tax has created a new subset of the whole startup ecosystem and created what is called as an eligible startup. So for being an eligible startup, you have the turnover threshold and you have to be, and they have created a time period saying that you should be incorporated after 1/4/2016 and you should be only up to 24. And this 24 is an adding year. Every year in the Finance Act, they amend this to one more year, they extend it by. So apart from this, you need to ensure that you are incorporated after 1/4/2016. Then only you become an eligible startup. And apart from that, it doesn't stop with that. You need to go apply one more form to the government and tell them, please kindly recognize me as an eligible startup. So you need to apply in Form 1. And this goes to one more division, which is called as the Interministerial Board. And once you go there, you get the benefit of a eligible startup. Now, commonly as a startup, these are the benefits that when you're a plain vanilla startup, these are the benefits that you have across different legislation. I just listed a few. There'll also labor legislations also we have, you have self-certification, everything. On company law, you have less hassle where you don't have to have too many work there. You can have 2 against 4 board meetings. Then they have given a kind of a what do you call the leeway in terms of allotting shares to directors. Normally you can't do, but in case of a startup, they say that okay, please go ahead and also allocate ESOP to directors. We recognize you and please go ahead and do that. And then this is one thing that please be aware, because sometimes the outcome of a due diligence is an offense for which there is a requirement of compounding. The good thing news you have is that under company law, you have certain discounts that are available as part of compounding. So if there are some regularization that you need to do because your books are not intact, there are some slips in your compliance. If you have to do some compounding under company law, you have a benefit there. Please use it, and please ensure that your registered DIPP certificate is available for that. They also allow fast track merger, as we know that merger itself is a hassle. No merger happens within a year. It at least take a royal 15 to 18 months for a merger to complete and take place. And they have provided this benefit saying that if you're a startup and we know that you're doing a restructuring for a certain requirement, we can fast track the entire merger exercise. Now, on the income tax side, this is the more interesting part, which is called as the angel tax. It is it's not enough to hassle them in so many ways that we have find out new ways to hassle startups. So one benefit that they give is that where you have investment coming into the company, you, as long as you are a startup, the if you are issuing shares at a premium which is above your face value, you can you have something called as an angel tax, where the differential between your issue price and your face value is offered to tax as income from other sources. They've given you that exemption saying that as long as you don't have any subsidiary or you don't have any investments or any investment in any LLPs or any other place or a land or building where you're just holding it for the sake of residential, or so you parked a certain asset with no purpose, as long as you don't have certain items which they have specifically called out, you are eligible to go raise and issue shares at a premium. And you often know why people go for a premium, because if you have to issue shares at par every time, the kind of funding rounds that we see, the stamp duty will be so enormous, it is definitely put a hole through your pocket. So it is not worthwhile to go through and pay out in terms of stamp duty. So people go for premium issue. So when you issue shares at premium, please make sure that though you're a startup, you have the DIPP mandatorily. Along with it, please also make sure that you go submit your form 2, which basically tells CBDT, and a mail automatically goes to the CBDT saying that, guys, I'm raising funds. Please don't tax me. I'm a startup. Please don't touch any of the income and bring it to tax under income from other sources. This is not automatic just because you're a startup. Please go fill that form. It is a one-time submission. It reduces so much hassles in future for scrutiny. Okay, so this is something which is very important and you need to be aware of. The other part is the FEMA part, where I already mentioned about, which was the convertible note part, where if you issue a convertible, you don't know your valuation, you can still go ahead so that you can do a valuation at a subsequent fundraise. You can determine what your valuation and create the amount. Now, so I was talking about the concept of what are eligible startups. So what do you get because you are an eligible startup? So basically, income tax gives out these main 4 things which are part of your eligible startup benefit. One is deferment of perquisite tax. So if you are an employee, please find out if you are part of an organization. It's not enough it's called a startup. It has to have the certificate from the interministerial board saying it is an eligible startup. If you are being allotted by an eligible startup, then you can defer the perquisite tax that is arising as a result of an ESOP scheme. Now, the benefit that is being given is that they say that the perquisite tax that is due because whenever you exercise the shares, you exercise the right to get the shares allotted in name, immediately the taxman brings it in the form of a tax withholding. So this particular tax is actually postponed to one of it, which is like 5 years from the year of your excise, or it can be the time when you're leaving the company, or it can be at the time of an exit that you're having. At that point of time, within 14 days, you have to fulfill the tax liability and pay it. But you get a leeway and breather space, because when you exercise, you'll be paying for shares, but you don't have money in hand. The money in hand is postponed to an exit scenario. So they actually give you a leeway there. The other part is which is called as the set off of loss. So very often that this cap table dilution, which I talked about, keep that intact so that you always know whether you are still holding 51% of the company or not. So if there is a clause which says that if you continue to hold 51% from the time whenever you incurred the loss, as long as that condition is satisfied, then you can set off the loss. Otherwise, that loss lapses. You can give it, it's completely written off. You can't use that loss at all. So this leeway has been given to startup. They say that, okay, you don't need to fulfill that 51%, but you can still continue to just as long as you are vested in the company, you might have diluted so much that you don't have control over the company, but you can still set off the losses. That is one of the benefits. The other thing is the 80 IAC, which is the deduction from profits, where they say 3 years, consecutive years out of a 10-year period from your incorporation, you can claim it as a deduction, and that is allowed as a allowable deduction. The other one is a softer benefit, which personally I've not seen lot of people actually avail this, which is a capital gain benefit. You sell any residential land or building, any land or building is being sold. You take the money and invest it in your eligible startup, which is your business again. They say that you can give a capital gain exemption for that. Now, moving further, this is the more interesting part, which is all the hazards. So we have discussed all the commercial side of it, where the investor is asking for so many rights, so many benefits, but untangling the mess of the valuation is something which is very, very tough sometimes. And we as professionals, we always foresee. So everything has been decided as part of an SHA. We have the term sheet. We know what is the valuation at which the fundraise is happening and all that. But there are so many hybrid instruments that I talked about that giving a valuation and accommodating everybody in within the valuation, it's a complexity by itself. Generally, whenever there is a fundraise, there are three main legislations that come into play. If you are a resident, then it is the Companies Act and the income tax, where you need to have, you have to go ahead and see what is the applicability. Am I in line with the requirements of the law? If you are a non-resident, you have an added complexity. Now, income tax rules have also been changed. They are going to accommodate a fundraise from a non-resident also within the ambit. Now we have an added complexity of FEMA as well. Now, the funny part is that each of these regulations talks about different valuation methodology. Now, Companies Act gives it to the registered value and says that you determine the value and you cannot issue shares below that fair market value. FEMA also is okay. It says, okay, go ahead, determine your fair market value. Don't issue below that fair market value. But in FEMA, it says, I don't recognize a registered value. Please kindly get hold of a chartered accountant or a merchant banker. In terms of income tax, though they like to call the CA there, they have very clearly kept us out and said that please don't take a report from a CA. Any valuation that you need to do, if it is fundraise, if it is an equity instrument, please go and get a DCF valuation. And then for the other instruments, they have brought in saying that internationally accepted valuation by a merchant banker. Now, this is something that everybody needs to be aware. I know that you need to have a certain level of professionals who will actually be guiding you through the fundraise, but this is something that is good to know, saying that you can't go give a value to everybody, to each person at a different level. When there is a funding happening, you cannot have too much variations between the prices that's been offered to different people. Even if there is a convertible that is being offered, be cognizant of the fact that there are complexities in valuation which you need to look into and see whether you're accommodating it. Otherwise, you're going to be in trouble either with a FEMA or it is with an RBI. Now, one second. Arun, can we just go to the previous slide?
Yes, ma'am. This one?
Yeah. So the other part we need to keep in mind is that when there is a secondary, as I was telling, when in the cap table management, when there is a secondary happening, you need to be cognizant of the fact that there is an income tax and there is also an added complexity if you are transferring between non-resident. There you have the concept of FEMA. Now, this is something you can't transfer it at any value. You have certain basic threshold values that has been provided under the provisions. keep note of it and then make a transfer. Otherwise, you're going to have a surprise of a capital gain which is going to hit you. So that is something that you need to keep in mind. Now, I was talking about convertible instruments and how it is actually beautiful in a startup space because you don't need to determine your value at the time of issue of the instrument. Now, when we operationally put it into use, practically when we have convertible instruments, you would, as long as the convertible instrument is converting at a subsequent round the same value as what other people are coming in, we have no challenges. But the convertible instrument person would also say that I have come to your company at a certain state, which is like where there was nobody else was actually in. I'm one of the early investors. So give it to me at a discount. Now, this is where the challenge is. Now you have a funding round which is happening at a certain value, and you have a convertible note person who is going to convert at a discount on that particular value. Now managing an FMV in this case becomes quite a bit of a challenge. So if you have convertibles, even though as per the regulations, there is no requirement for you to have a valuation report, we strongly advise if there is likely to be a discount in the future, have a valuation beforehand for a convertible instrument. Otherwise, it becomes very, very difficult to justify and subsequently file with the RBI. And RBI offenses always result in compounding. We don't want to go down that road. So please ensure that you have a valuation for convertibles if there is going likely to be a discount for the convertibles in the future round. Now, lot of valuation, we see so many terminologies as part of valuation where you have a floor valuation when you have a cap. Now, whenever there is a floor valuation, please go through the term sheet, have an idea. Okay, this is where is the bare minimum value that person is going to convert it. If there is a subsequent funding round and it's going to be a higher value and a discount on that, that is not a hassle because you know that the value happens at that time. You can have a buffer there. But if there is a value which is like a floor valuation that the person, say for example, 1 crore says whatever, if there is no increase even, I cap my saying that at 1 crore, I will actually convert and I will be offered equity stake as this bare minimum valuation, then always ensure that there is a valuation to support you at the floor. Otherwise, the problem of differential valuation and exposure to income from other sources and the income tax is quite common. Now, these are the recent changes that has been proposed as part of our new 11 UA that was amended, where they decided that any fund money that is being raised by a initially it was money raised by a resident. From a resident, you have to offer it to tax if it is more than a if it's more than a face value. But now, along with the resident, they also decided to bring in a non-resident. Mind you, these regulations are still under draft mode and have not yet been implemented. We are still waiting for a final circular saying that this is official. But here now, what they have said that if you have a resident has only DCF which he needs to look at. But because a non-resident is a new tribe who are actually coming in, the government has decided to accommodate them and say that if you're raising money from a non-resident, then you have other methods that can be used, and they have notified 4 or 5 more methods. Now, you need to have also this is if it is a startup, you're still out of the exclusion list. Please make sure that you don't have a subsidiary subsequently. That will help you a long way. As long as you're a startup, you are away from all these new regulations and you are still within the exemption level. But if you are a person other than a startup, you are moved out of the startup space, you have become, if you exceeded, if your turnover has exceeded, then you need to be aware of this. So if you issue any dilutive instrument or any convertible instrument, all you have is a 10% safe harbor rule that is available. And as long as your offer price is from the FMB, it is moving up to 10%, you are safe. If it is anything higher, there is a option, there is a possibility that you have an exposure to angel transfer. So, and also they have notified certain non-resident, the general, and it is one more additional thing that I would like to add is that you have a price matching. So if you have VCs as part of the round, you, as long as your price is matching to the VC, they say that you are covered by 5627B and you don't have any exposure to taxes. That is a good benefit that you have. But there has been a lot of people asking me that, okay, if I receive money from US, am I into that exemption list? Please note that there is nothing like that. It is only for specified funds. And if you qualify as you have so many investors in that fund, or if it is a sovereign fund or a pension fund, Only there are certain notified category of people where they have notified certain places around the globe, and there is a huge list that's been given. As long as the funding is coming from that zone, you are under the safe zone and you can go and issue without issues of angel tax under the income tax. Now, this is something I just want to showcase, saying that what is that extra that non-resident is getting. Apart from DCF, they have recommended option pricing methodology, probability weighted average method, and comparable company method. Now, I would personally like to see how this pans out in the future, because we have been having a lot of questions on scrutiny about DCF itself. Now, income tax has not started testing what is the new methods and option pricing. So we will have to see how they are going to digest it in a long term. So only after 5 years, we'll kind of know, as part of scrutiny proceedings, what actually goes through. If this legislation goes through, how they are going to take it up. And now they have very clearly said that everything is part of merchant banker. So they need the valuation report from a merchant banker if you have an FNB. So over to you, Arun. I think we have come to the end of the session.
Thank you, Mythili, and thank you for heavy lifting in this session. And friends, we will just open up for Q&A. In the meantime, I request my colleague to launch another poll, which is the last poll in the webinar. Request you all to attempt it and respond to the poll. And let me give the rights to unmute. Of course, I would want to thank fellow chartered accountants, Mr. Rajiv and Mr. Chandra Shastri, who gave their valuable inputs, which we covered in our session. They act as CFOs, virtual CFOs. Sima, I think we have the rights for the guests who can unmute and then ask any questions.
I think there are a couple of questions in the Q&A.
Yes, and I'm able to see.
Yeah.
The first one is kindly share recorded session. Of course, we will be uploading it into our YouTube, and then we will share the link with you all, certainly. And next question is angel tax concept. Please explain. Startup issuing at fair value as determined by registered value. Is this still taxable as it is at premium? So for income tax, yeah, go ahead, ma'am. Go ahead.
So for income tax, the problem is that it doesn't recognize a registered valuer. So they would probably insist on a merchant banker valuation if they really want to push it that way. But all said and done, it's still a valuation. But you never know how income tax reacts. So they will still ask you for a, please say that, they will say that this is not a recognized person to issue a report. So please kindly get one issued by a merchant banker. So you might still have to go there.
Great. The next question is to get tax exemption, approval from BPIT is sufficient, or still we have to get approval from IT department? Explain the process.
So what happens is that once you have the DIPP registration, you can have access to your Startup India website. So you can create a login and all that happens. There is one self-declaration that is provided in the Startup India, where you say that I am raising funds for so and so, whatever it is. It is just a standard text that has been provided. You just go and please submit that. You don't need to do anything. Once you submit it, automatically DPIT itself sends it across to CBDT marking a copy. And you will get a confirmation saying that CBDT has also received this particular and you're raising funds. So it is more like a trigger and it's an auto mail. You don't need to specifically write somewhere or go anywhere for this. But it is just an automated process as part of your login credentials in Startup India.
Yeah, just to add there, Mythili, the other one that is AT-IAC deduction, which is important. For that, interministerial approval is a must, and hence that has to be followed up. And what we understand is the board, interministerial board, meets regularly and then take up the cases for approving it as an eligible startup. So one is registering as a startup, another is being called as eligible startup. So for that, the interministerial board has to provide approval. Then alone, ATIAC, that is the main tax holiday of 3 years out of 10 years, would be eligible for that particular startup. Yeah. Next question is, what is the difference between convertible note and CCD?
Now, convertible note is an acknowledgement of a debt. There is no instrument that is allocated. It's just saying that you're in receipt of debt from the particular person. CCD, the difference also comes around in terms of regulations that is driving the Companies Act in terms of issue of how the both agreements are issued and how it is worded. CCDs essentially are actually a debenture. It's an instrument by itself. So you have certain requirements with regard to issue guidelines that you will have to follow. But in terms of fully diluted basis, both have a conversion ratio, and you will have to see how it actually pans out when you do the a number of equity shares. Anything to add on there, Arun?
Yeah, I think you have covered. It's mainly the debt versus treating it as quasi debt. That is one. Of course, the compliance part with respect to ROC. I think that's it. The next question is there any criteria on the period within which a startup has to be incorporated to be eligible? Yeah, sorry.
Ms. Mythili has answered that question through a
Okay.
session. Okay. Just I have another question.
Please go ahead.
In case you have a valuation, I'm not talking about this DAPB registered company. A normal private company, if it wants to issue shares, they require a valuation for the company law purposes. In that case, also they need for the income tax purpose, they'll have require a valuation from a merchant banker.
Unfortunately, yes, sir.
Okay. Okay.
So even though it's a registered valuer and they both are professionals, you still have that requirement of valuation from a merchant banker, because the law is sometimes an ass. It has no brains of its own. So it depends on the person who is actually drafting it. So they have decided to have a different set of people for income tax and FEMA, and they have a different set of people for Companies Act. It's quite unfortunate, but we are hoping there'll be a rationalization of regulations at some point of time.
Okay. A CA also cannot do that for income tax.
CA, I would say that a CA cannot do it for equity shares under income tax. You can do it for other instrument, but generally, what we have seen as part of practice scenario is that CA's valuation, they love to find loopholes there, and sometimes we have to educate the income tax officer as well as to what is a DCF, because they have this habit of comparing actuals and this thing after 4 years when they have the benefit of hindsight. So it's sometimes challenging. Because I think merchant bankers are more SEBI regulated as well. They feel that they have a stronger regulation there, so they are more amenable to a MB valuation as well. But you are still compliant for other securities as long as you have a CA valuation. You are covered there actually.
It would be very expensive for small private limited company. You just started.
Oh, yeah. Tell me about it. Sometimes you really feel sad, but what do you see? What do you say? The compliance of law. That's how it works. The compliance cost is huge. But the problem is you have scrutiny proceedings doesn't happen live, right? It happens 3 years later. So that becomes an added challenge.
Okay. So see, actually, I'm a registered valuer under CA also. So if I do a valuation for a company, small private limited company, then the income tax doesn't accept it. And after 3 years, what do they do?
They will ask you for one more valuation. You'll have to go back and say, you have to validate your value.
Okay, fine. Okay.
Thank you. Thank
What
you.
is the name of your YouTube channel?
It's Anveshan. Anveshan.
Anveshan, okay.
Yes. So we have uploaded other previous webinars also. You can go and access them.
Which of your webinars?
Yeah, previous webinars. This webinar recording also will be uploaded onto that YouTube channel.
What is the frequency of your webinars? Do you frequently host webinars?
Generally, we try to have it monthly once or once in 2 months. We will try to make it more regular going forward.
Okay, thank you. Very informative webinar.
Thanks a lot,
Actually,
sir.
put one only in the middle.
Yes. Thanks a lot, and we would invite feedback, and then we would also want to have inputs on what more topics that we can cover. Of course, today we try to touch upon different aspects of the startup, which may be informative for the promoters, for the practicing professionals, as well as the CFOs. But of course, each of these topics are in itself, very in-depth action items that can be converted into a webinar. So we look forward to have this in detail in future.
So what sort of topics you intend to cover? Do you want the feedbacks?
So we would be sharing our feedback form, sir, on emails, on your registered emails, and we would request you to share your feedback.
Okay. It could be anything.
Yeah, absolutely, sir. Because we believe in sharing and learning through the process. So I think.
Yeah. Okay. Thank you.
Thank you. Yeah, there are two more questions, Mythili. Let's try to address. Under exit, is buyback or put option are valid under law? Let me take this question. See, buyback, of course, it's a promise made by the company or the promoter to buy back, either through buyback regulations under ROC or promoters promising that at a certain price, they would buy it from the investors. So since it is a contract between two parties, I don't see anything against the law, against any other law, any law. So it is still valid, and it's a promise made by the promoter or the company to the investors. Even put options are contractual obligations, and there again, I do not foresee anything being against any law, as long as it is well within the Indian contract. So the other question is throw some light on ESOP, that is max allowed in any cap table. Generally, ESOPs are in the range of up to 15%, and normally we see 10% as the cap table threshold, the earmark for ESOPs. Generally, that is what we have seen. Of course, there are no regulatory around how much should earmark for ESOPs. It's just an industry practice. Is SSA agreement is mandatory? In many cases, SSA was not done. Only SHA was signed. It's okay. SSA is event based. SSA is nothing but on what terms the shares are being subscribed. There are certain rights that shareholders get under SSA. As long as those rights are covered under SHA, I don't foresee SSA to be a separate agreement. Some people club both SSA and SHA into one document itself. They call it as SH and SA, shareholders and share subscription agreement. So as long as the rights are covered, terms and conditions are covered, the future unforeseen situations are covered, I don't see SSA needs to be signed separate. Any more questions? We are happy to take for next 2 minutes. We are already at 5:32. So I think we shall conclude the session here. It was wonderful having you all here and having a patient hearing through our presentation. And we will ensure that the recording reaches out to you through our YouTube. We will send out an email. Also, we will share our feedback forms. Request you to provide your feedback, which will help us better in our future webinars. Thanks a lot.
Thank you all, and a special call out to our team for actually putting together this presentation. And thank you one and all for attending this. Really appreciate it. Have a good evening.